has learned another round of W-2s are going out to some state employees with less than a month until the end of tax season.
Most people think they know what they pay in taxes. They look at their W-2 at the end of the year, they see the federal income tax withheld, maybe they grumble about the number, and they move on. They think that is the bill. It is not even close to the full bill. The average American household pays an effective total tax rate that is significantly higher than their federal income tax bracket suggests. And a substantial portion of that difference is made up of taxes most people either do not recognize as taxes at all, or do not realize they are paying in the amounts they are. Here is a number that tends to stop people cold. According to the Tax Foundation, when you stack federal income tax, payroll taxes, state income taxes, sales taxes, property taxes, excise taxes, and various fees and levies together,
we pay federal taxes, state taxes, property taxes, tax on gas, alcohol, cigarettes, diapers, tampons, clams.
The average American household sends somewhere between 30 and 40% of its total income to government in one form or another. For median income households, that figure sits around 32 to 35%. But when you ask the average person what percentage of their income goes to taxes, most guess somewhere between 15 and 22%. The gap between perception and reality is not a rounding error, it is a chasm. And that chasm exists precisely because the tax system is structured in a way that makes the full cost invisible. This is how taxes work in practice versus how most people understand them. Today we are pulling back every layer. Tax brackets explained properly, hidden taxes named and quantified, and the specific traps that quietly push your effective rate far higher than you realize. If you have ever looked at your paycheck and felt like something does not add up, you are right. Let's get into it. Chapter 1. The bracket myth that almost everyone believes. Before we get to the hidden taxes, we need to fix a foundational misunderstanding that affects how the majority of Americans think about their own tax situation. It is the single most common misconception in how taxes work, and it costs some people real money because of the decisions they make based on it. The myth is this, that earning more money and crossing into a higher tax bracket
creep happens when workers begin to earn more money and start to creep up into higher tax brackets.
means your entire income gets taxed at that higher rate. It does not. And the confusion this causes is significant. Here is how tax brackets explained correctly actually work. The United States uses a progressive marginal tax system. What that means in practice is that your income is divided into chunks, and each chunk is taxed at the rate that applies to that specific range of income, not to your total income. For 2024, the federal income tax brackets for a single filer work like this. The first $11,600 of taxable income is taxed at 10%. Income from $11,601 to $47,150 is taxed at 12%. Income from $47,151 to $100,525 is taxed at 22%. Income from $100,526 to $191,950 is taxed at 24%, and so on, up to the 37% bracket that applies to income above $609,350, according to IRS 2024 tax year tables. If you earn $60,000 in taxable income as a single filer, you do not pay 22% on all of it. You pay 10% on the first $11,600, 12% on the next $35,550, and 22% only on the remaining $12,850 above the 22% threshold. Your effective federal income tax rate on $60,000 of taxable income is closer to 14%. Not 22%. This matters because people who misunderstand how tax brackets work sometimes make decisions that cost them money. They turn down raises because they think the raise will be taxed away entirely. They avoid converting retirement accounts in ways that would be beneficial. They do not negotiate for additional compensation because they assume the government takes most of it. The misconception has a real financial cost. Getting tax brackets explained correctly is the starting point for understanding the rest of what we are about to break down. Chapter 2. Payroll taxes. The hidden tax nobody talks about. Here is where how taxes work gets genuinely uncomfortable for most people, because this is the hidden tax that hits hardest at the middle and lower end of the income distribution, and it almost never comes up in conversations about tax rates. Payroll taxes are separate from federal income tax. They fund Social Security and Medicare, and for employed workers, they are split between you and your employer. The employee pays 6.2% of wages for Social Security, up to a wage cap of $168,600 in 2024, and 1.45% of all wages for Medicare.
Back, the IRS has announced new federal income tax brackets and standard deductions for next year. The new policies kick in at the start of the new year and will apply to income earned
for a combined employee-side payroll tax rate of 7.65%. Your employer pays an identical 7.65% on top of that on your behalf. But here is what most people miss. If you are self-employed, you pay both sides, the full 15.3%. That is the self-employment tax. And it is one of the most jarring financial discoveries freelancers and business owners make when they first encounter it. And here is the structural problem that makes this one of the most significant hidden taxes in the American system. The Social Security portion of payroll tax has a wage cap. In 2024, that cap is $168,600. Above that income level, you pay no additional Social Security tax, which means that someone earning $168,600 pays exactly the same dollar amount in Social Security tax as someone earning $500,000, or $2 million. As a percentage of income, payroll taxes are regressive. A person earning $50,000 pays 7.65% of their entire income in payroll taxes. A person earning $1 million pays 7.65% on the first $168,600, and then a diminishing fractional rate on the rest. Their effective payroll tax rate as a percentage of total income might be under 2%. This is not an accident of the system. It is a structural feature of how taxes work that distributes the payroll tax burden heavily onto middle-income earners and lightens it significantly at the top. The Congressional Budget Office has documented this regressive structure in detail in its annual analyses of effective tax rates by income group. Most Americans paying payroll taxes every paycheck have no idea this is the shape of what they are paying. Chapter 3. The stealth tax of bracket creep. This is one of the most insidious hidden taxes in the modern system, because it operates without anyone voting for a tax increase and without any announcement. It is called bracket creep, or in its most extreme form, fiscal drag. Here's how it works. The federal government adjusts tax brackets for inflation each year. That sounds responsible, but the adjustment only covers the officially measured consumer price index, the CPI, which has been criticized by economists, including those at the Bureau of Economic Analysis, as underestimating the real cost of living growth in key categories like housing and healthcare. If the CPI says inflation was 4%, but your actual cost of living rose 6%, the bracket adjustment does not keep pace with the real erosion of your purchasing power. At the state level, the problem is more acute. Many states do not index their tax brackets for inflation at all. In those states, inflation-driven wage increases push workers into higher marginal brackets, even when their real purchasing power is flat or declining. You earn more dollars, pay a higher marginal rate on those additional dollars, and end up with less real purchasing power than before the raise. The government collects more in real terms without passing a single piece of legislation. This is how taxes work at the system level. The default is extraction. Without active adjustment, inflation continuously expands the effective tax burden on working people. And the people with the most political and financial resources to navigate this, through deductions, credits, strategic income timing, and tax-advantaged accounts, are the ones best positioned to resist the creep. The Tax Policy Center has estimated that in states without inflation indexing, a worker at the median income level can see their effective state income tax rate rise by 0.5 percentage point or more over a decade, purely through bracket creep, without any legislated tax increase. Over a working lifetime, that adds up to tens of thousands of dollars. Chapter 4. Sales tax, excise tax, and the hidden taxes in every purchase. Federal income tax brackets explained and payroll taxes are the taxes most people at least partially understand. What follows is the layer that is almost entirely invisible, the hidden taxes embedded in virtually every transaction you make. Sales tax is the most visible of these. In the United States, sales tax rates vary by state from 0 in Oregon, Montana, New Hampshire, Delaware, and Alaska to over 10% in parts of Louisiana and Tennessee when state and local rates are combined.
Okay, you know, the standard deduction is the amount of money that kind of gets lopped off of the income, and then the IRS taxes everything after that.
According to Tax Foundation 2024 state sales tax data, the average combined state and local sales tax rate nationally is approximately 7.1%. Every time you buy something taxable, that percentage is leaving your pocket for a government account. But sales tax is at least visible on the receipt. Excise taxes are not. Excise taxes are hidden taxes embedded directly into the price of specific goods before you ever see a price tag. You do not see them as a separate line item. You simply pay a higher price. Federal excise taxes apply to gasoline at 18.4 cents per gallon, to diesel at 24.4 cents per gallon, to commercial airline tickets at 7.5% of the fare plus per segment fees, to alcohol, with rates varying by type and alcohol content, to tobacco products, with federal cigarette taxes at $1.0066 per pack, to tanning services, firearms, ammunition, telephone service, and tires, among others. These are all permanent additions to the price of those products that are technically taxes, not costs, but that most consumers simply experience as the price. At the state level, gasoline excise taxes add another 20 to 60 cents per gallon, depending on the state, according to the American Petroleum Institute's state tax data. In California, the total state and federal excise tax on a gallon of gasoline exceeds 85 cents per gallon before any sales tax is applied. Add it all together. For a median income household that pays state and local sales tax on most of its non-housing spending, federal and state excise taxes on gasoline, alcohol, and tobacco, plus various telecommunications taxes and fees, the hidden transaction taxes can easily amount to $2,000 to $4,000 per year in costs that never appear on any single tax document and that most people never aggregate into their understanding of how taxes work. Chapter 5. Property tax and the wealth illusion. For the majority of American households, property tax is the second largest tax payment they make after payroll and income taxes. It is also the one most people dramatically underestimate over a lifetime of home ownership. The national average effective property tax rate is approximately 1.1% of assessed value per year, according to data from Atom, a property data analytics company. But effective rates vary enormously. In New Jersey, the average effective rate exceeds 2.2%. In Illinois, it is over 2%. In Texas, which has no state income tax, property tax rates compensate. The average effective rate exceeds 1.6%. On a $400,000 home at a 1.5% effective rate, that is $6,000 per year in property tax. Over a 30-year ownership period, assuming modest assessment increases, a homeowner can easily pay $200,000 or more in property taxes on a home that cost $400,000 to purchase. That is a hidden tax in plain sight, one that runs for as long as you own the property, regardless of whether you have a mortgage, regardless of whether you are earning income, and regardless of your ability to pay. The property tax trap tightens particularly hard on older, fixed-income homeowners who bought their properties decades ago. Their income is flat or declining, but their assessed property value, and therefore their tax bill, continues to rise with the market. Some states offer homestead exemptions, senior freezes, or circuit breaker credits that limit this exposure. Many do not. And many homeowners are unaware of the relief programs available to them even in states that have them, because the tax system does not proactively notify people of benefits they qualify for. This is how taxes work at the local level. They are permanent, they rise with asset values, and they are often effectively invisible because they are wrapped into mortgage escrow payments or they disappear from monthly budgeting awareness. Chapter 6, the AMT Trap, and why it still catches people.
For the alternative minimum tax. What is the alternative minimum tax?
The alternative minimum tax was designed in 1969 to ensure that wealthy individuals who used aggressive deductions and tax shelters could not reduce their federal income tax to zero or near zero. In 1969, it affected 155 Americans. At its peak, before the 2017 Tax Cuts and Jobs Act, it was affecting over 5 million taxpayers, according to the Tax Policy Center, many of whom were solidly upper-middle-class professionals, nowhere near the ultra-wealthy bracket it was intended to target. The TCJA raised the AMT exemption significantly and indexed it to inflation, which reduced the number affected. But the AMT still exists and still catches people who are not expecting it, particularly those in high-tax states, those with significant incentive stock option income, those with large depreciation deductions, and those with certain business income structures. Here is how it works. The AMT is a parallel tax calculation. You compute your tax under the regular system, then you compute it again under the AMT rules, which disallow many common deductions, including state and local tax deductions and certain business expenses. You pay whichever amount is higher. The trap is that the AMT can trigger suddenly when your income jumps, when you exercise stock options, or when your deduction profile changes in a way that makes the AMT calculation land higher than the regular calculation. People who have never had to think about the AMT encounter it for the first time as a hidden tax on what they assumed was a straightforward income year. For anyone with variable income, significant equity compensation, or complex deductions, understanding the AMT is not optional. It is one of the hidden taxes that can add thousands of dollars to a tax bill with no warning and no intuitive explanation if you have not specifically sought out how this part of how taxes work actually functions. Chapter 7, Sin Taxes and the Quiet Discrimination of Hidden Taxes. Excise taxes on alcohol, tobacco, gambling, and cannabis, collectively called sin taxes, are sometimes discussed as if they are morally neutral user fees on discretionary choices. The data tells a more complicated story. Sin taxes are among the most regressive forms of hidden taxes in the modern system. They fall most heavily as a percentage of income on lower income households because lower income households tend to spend a larger share of their income on the taxed goods. A federal excise tax of $1.01 per pack of cigarettes costs a pack-a-day smoker earning $30,000 roughly 1.2% of their annual income, just in federal cigarette tax. For someone earning $200,000, the same consumption pattern costs 0.18% of annual income. Same behavior, dramatically different proportional cost. The Tax Foundation has documented that tobacco taxes specifically are among the most regressive taxes in the US system, with the burden falling 2 to 3 times more heavily on lower income households as a share of income compared to upper income households. Cannabis taxation adds a modern layer to this dynamic. In states where cannabis has been legalized and taxed, effective tax rates, including state excise tax, sales tax, and local levies, can exceed 30 to 40% of the retail price. In California, the combined effective tax rate on cannabis purchases has been estimated at over 35% in some jurisdictions, including a 15% state excise tax, state and local sales tax, and additional local cannabis taxes, according to analysis by the California Policy Center. These are hidden taxes in the truest sense. They are embedded in prices, they are paid disproportionately by people with the least ability to absorb them, and they generate revenue that is rarely hypothecated back to the communities most affected by the behaviors being taxed. Chapter 8. Inflation as a hidden tax. The one nobody voted for.
Over 8 million New Yorkers will receive inflation refund checks. But how do you get them?
This is the hidden tax that no legislature explicitly passes and no IRS form captures, but that functions in practice with the same effect as a direct levy on your savings and income. Economists call it the inflation tax, and understanding how it works is fundamental to understanding how taxes work at the systemic level. When a government runs large deficits and the central bank expands the money supply to accommodate that fiscal expansion, the resulting inflation reduces the real purchasing power of every dollar in circulation. This is a wealth transfer from dollar holders to the entity issuing the dollars. It functions identically to a tax in its distributional effect. Value is taken from savers and transferred to the deficit spending entity, without any explicit authorization from the people paying it. Between 2020 and 2023, the M2 money supply in the United States expanded from approximately $15.4 trillion to over $21 trillion before beginning to contract, according to Federal Reserve data. The inflation that followed, peaking at 9.1% in June 2022, according to BLS-CPI data, eroded the purchasing power of cash savings held by households who were not positioned in inflation-resistant assets. A household that held $50,000 in a savings account earning 0.5% interest during a year of 8% inflation effectively paid a hidden tax of roughly 7.5% on that savings. The dollar amount in the account was slightly higher at year-end. The purchasing power it represented was significantly lower. That gap is the inflation tax, and it was paid by millions of American households simultaneously, invisibly, without a single vote being cast on it. For savers who have spent decades being told that keeping money in savings accounts is responsible financial behavior, the inflation tax is a particularly cruel hidden levy. The responsible behavior, the one that feels safe and conservative, is precisely the behavior most exposed to the inflation tax. Meanwhile, asset holders, whose portfolios rise in nominal value with inflation, pay the inflation tax at rates that approach zero on their non-cash wealth. Chapter 9. Fees, fines, and the government revenue that isn't called a tax. There is an entire category of government revenue that does not appear in any conversation about tax brackets explained or effective tax rates, because it is technically not classified as taxation. It functions identically to taxation in its effect on your finances. It is the world of fees, fines, licenses, tolls, and civil penalties. Vehicle registration fees, driver's license renewal fees, building permit fees, business license fees, professional certification fees, passport fees, airport facility charges, toll road fees, parking fees on public property, court filing fees, recording fees for real estate transactions. All of these are government-imposed charges that are mandatory for participation in normal economic and civic life. None of them show up in your tax return. In many municipalities, fines have become a significant revenue generation mechanism that functions as a hidden tax on residents with the least political power to resist it. The Department of Justice's 2015 investigation into Ferguson, Missouri, following the events of 2014, found that the city had built a significant portion of its municipal budget around traffic fines and court fees that fell disproportionately on lower-income residents. This was not an isolated case. A 2019 report by the National Center for State Courts found that excessive fines and fees in the justice system had become a substantial and regressive revenue source across dozens of jurisdictions. Toll roads deserve specific attention. As road infrastructure has increasingly shifted to public-private partnership funding models, toll collection has expanded significantly. The International Bridge, Tunnel, and Turnpike Association estimates that American drivers pay approximately $15 billion per year in tolls. That is $15 billion in transportation costs that is effectively a tax on road use, collected on top of the gasoline excise taxes and vehicle registration fees already paid, and distributed between government entities and private investors depending on the specific toll authority structure. These hidden taxes collectively represent billions of dollars in annual extraction from household budgets that never appears in any discussion of effective tax rates, tax brackets explained, or how taxes work in the standard educational sense. Chapter 10. The deduction system that works better for the wealthy.
While it's easier than ever to do your own taxes, professional help can save you money and trouble.
One of the structural features of how taxes work that quietly amplifies the effective tax burden on middle-income households while reducing it for higher-income households is the deduction system. Deductions reduce your taxable income. The dollar value of a deduction is your marginal tax rate multiplied by the deduction amount, which means the same deduction is worth more to someone in a higher bracket than to someone in a lower bracket. A $10,000 mortgage interest deduction for someone in the 22% bracket is worth $2,200 in reduced tax liability. The same deduction for someone in the 37% bracket is worth $3,700. The higher income taxpayer gets 68% more benefit from the same deduction, simply by virtue of being in a higher bracket. This structural feature runs through every itemized deduction: charitable contributions, state and local taxes up to the $10,000 cap, mortgage interest, business expenses. In every case, the tax benefit scales with the marginal rate, which scales with income. Additionally, as we discussed in the mortgage context in another video, only about 13% of taxpayers currently itemize deductions at all, following the near doubling of the standard deduction in 2017. The deductions most powerfully tilted toward high-income earners, the ones above the standard deduction threshold, are the ones that most middle-income taxpayers cannot access, because their total deductible expenses do not exceed the standard amount. Above-the-line deductions, which reduce adjusted gross income regardless of whether you itemize, are more democratically available. Student loan interest deduction, IRA contribution deductions, health savings account contributions, self-employed health insurance premiums. These are the deductions that middle-income taxpayers are most likely to benefit from, and they are also among the least known and least utilized, because the tax system does not teach you how it works. You have to find out for yourself. Chapter 11, the capital gains preference and what it means for your tax bill. This is the tax provision that provokes more debate than almost any other, and understanding it is essential to a complete picture of how taxes work across the income spectrum. The United States taxes long-term capital gains, profits from selling assets held longer than 1 year, at preferential rates compared to ordinary income. For 2024, the long-term capital gains tax rates are 0% for income up to $47,025 for single filers, 15% for income between $47,026 and $518,900, and 20% for income above that, according to IRS 2024 guidance. Compare that to ordinary income tax brackets. Wage income above $47,150 is taxed at 22%. Wage income above $100,525 is taxed at 24%. A dollar earned by working is taxed at 22 to 37%, depending on your bracket. A dollar earned by selling a stock you held for over a year is taxed at 15 to 20%. The differential is significant and structurally favors income derived from capital ownership over income derived from labor. This capital gains preference is one of the primary reasons why the effective federal income tax rates of extremely wealthy individuals are often lower, as a percentage of total income, than the effective rates of upper middle class professionals. Warren Buffett has publicly noted that his effective federal income tax rate was lower than his secretary's because the majority of his income came in the form of capital gains and qualified dividends taxed at preferential rates, while his secretary's income came in the form of wages taxed at ordinary income rates. The capital gains tax preference is not a hidden tax in the literal sense. It is a published feature of the tax code. But it is effectively a hidden subsidy for capital income over labor income, and its existence means that two households with the same total income can face dramatically different effective tax rates depending on the source of that income. Understanding this is not optional for anyone trying to build a complete picture of tax brackets explained in practice. Chapter 12, how to reduce the total tax burden legally. The purpose of understanding how taxes work in their full complexity is not to generate despair. It is to identify the specific leverage points where deliberate action reduces the total bill. The most powerful tool available to the majority of households is tax-advantaged retirement account maximization. Contributions to a traditional 401k or traditional IRA reduce taxable income dollar for dollar in the year of contribution. For 2024, the 401k contribution limit is $23,000 or $30,500 for those 50 and older. The IRA contribution limit is $7,000 or $8,000 for those 50 and older. A married couple who both max out their 401k contributions reduces their joint taxable income by $46,000 before considering any other deductions. At a 22% marginal rate, that is $10,120 in federal income tax not owed this year. That money continues to grow tax-deferred until withdrawal. Health savings accounts, available to people enrolled in qualifying high-deductible health plans, are arguably the most tax-efficient account in the entire U.S. tax code. Contributions are pre-tax. Growth is tax-free. Withdrawals for qualified medical expenses are tax-free. No other account offers triple tax efficiency. The 2024 contribution limit is $4,150 for individuals and $8,300 for families, according to IRS guidance. For the self-employed, the tax leverage points are even more significant. A solo 401k allows contributions of up to $69,000 in 2024. Business expenses, home office deductions, vehicle use, health insurance premiums, and retirement contributions all reduce self-employment income before the 15.3% self-employment tax is applied. Strategic use of these deductions is one of the primary reasons that incorporated self-employed individuals often face a meaningfully lower effective total tax rate than comparably paid employees. On the investment side, tax loss harvesting, the practice of selling losing positions to realize a loss that offsets capital gains elsewhere in the portfolio, is a legitimate and legal method of reducing capital gains tax liability. Index fund investing in taxable accounts is more tax efficient than active fund investing because lower turnover generates fewer taxable events. Locating tax-inefficient assets like bonds and REITs in tax-advantaged accounts while holding tax-efficient assets like index funds in taxable accounts further reduces the annual tax drag. None of these strategies are secrets. They are features of the tax code that exist specifically because Congress created them, but you have to know they exist to use them. And the people who know they exist and use them consistently pay meaningfully less in total taxes over a lifetime than people with identical incomes who do not. Chapter 13, the system behind the system. There is a reason the US tax code runs to over 70,000 pages, and it is not because taxation is inherently that complicated. It is because the code has been built, provision by provision, over decades of legislative action, influenced by the entities with the most to gain from specific treatments. The carried interest provision, which allows private equity and hedge fund managers to have their compensation taxed at capital gains rates rather than ordinary income rates, has been the subject of reform proposals for over 15 years and remains in place despite broad bipartisan acknowledgement that it lacks a strong policy rationale. The cost of the Treasury has been estimated at several $1 billion per year, according to the Congressional Budget Office. The stepped-up basis rule allows heirs to inherit appreciated assets without paying capital gains tax on the appreciation that occurred during the original owner's lifetime. A stock portfolio that was worth $100,000 when purchased and is worth $2 million at death gets inherited at the $2 million basis. The $1.9 million in appreciation is never taxed as capital gains. This provision benefits only those with significant inherited wealth and represents one of the largest hidden subsidies in the tax code, estimated by the Tax Policy Center at over $40 billion per year in foregone revenue. The 1031 exchange provision allows real estate investors to defer capital gains taxes indefinitely by rolling proceeds from one property sale into another qualifying property purchase. Used repeatedly over a career, this allows real estate investors to accumulate wealth through a series of appreciation cycles while deferring tax on each one until a final sale, which often never comes because the property is passed to heirs under the stepped-up basis rule. These are not hidden taxes in the conventional sense. They are hidden advantages embedded in the tax code for specific categories of income and asset ownership that systematically reduce the effective tax burden for those who know how to use them, and that are funded implicitly by the tax burden falling more heavily on those who do not. This is how taxes work at the structural level, and knowing the structure is the beginning of navigating it effectively. Closing reflection. Here's the question I want you to sit with right now. Do you actually know your effective total tax rate? Not your federal income tax bracket, not the number on your W-2, your total effective rate, including payroll taxes, state income taxes, property taxes, sales taxes, and the various excise taxes embedded in your everyday spending? Most people have never calculated it, and most people who do are surprised by how high it is. Here is what I want you to do before you close this video. Take one actionable step. Find out whether you are fully utilizing the tax-advantaged accounts available to you: 401k, IRA, HSA if you qualify. These are the single most powerful legal tax reduction tools available to ordinary households, and the data consistently shows that most eligible people are not maxing them out. Drop a comment below and tell me, which part of this surprised you most? Was it the regressive structure of payroll taxes? The hidden taxes embedded in everyday prices? The provisions in the tax code that you did not know existed? I want to know what landed, because the comments on these videos consistently surface the best follow-up topics. And if this kind of breakdown is useful to you, subscribe to this channel, because we do this for every system that quietly takes money out of your pocket while the full mechanism stays invisible. Tax brackets explained properly. Hidden taxes named and quantified. The structural advantage is mapped out so you can use them instead of being used by them. The tax system is not designed to be understood by the people paying it. That is not an accident. But you can understand it. You just did.